Hi there. Welcome back to another edition of Premier Investments and Wealth Management Financial Program. My name is Doug Wagner. I'm your host. Before I introduce the other two gentlemen in the room with me, I would like to ask you a question. Are you ready for retirement? Well, if you're like maybe 75% of the people in the United States right now, you don't know. It's not, no, I'm not, or yes, I am. It's, you just don't know. You deserve to have an answer, and that's why we're here. Premier Investments and Wealth Management have the professional wealth advisors to help you take that next step. I want you to grab your phone, your tablet, your laptop, or maybe you're sitting at a desktop, open up your favorite browser, and go to premieriwm.com. Click on Get Started, answer a few questions, and Premier Investments will provide for you a one-page Premier Vision document, sort of like a roadmap. It's easy to read, and it's very concise. One page. Now, there's hundreds of pages behind it. It can be really complicated back if you want to see that stuff. But if you just want the one-page summary, they'll give it to you after you sit down with them for a free, no-obligation consultation. premieriwm.com. Click Get Started. Fill out the questions and get the answers to them. Get the one-page Premier Vision document, and they will call you to make an appointment to sit down with you and go over that today. If you want to find out more, if you just feel like calling to make the appointment yourself, get in touch with them, 800-383-6590. Directly to my right, he's a wealth advisor, accredited investment fiduciary, certified financial planner professional with over 10 years of experience in the investment industry. He is Dr. Casey Mushrush.
Just you, Doug.
That's JD, by the way. Elias Randall's the new sheriff in town. He's a vice president and wealth advisor at Premier Investments and Wealth Management. Happy day to you, sir. How are you?
Excellent. Happy to be here. Happy to be with you, Doug.
I'm glad to have you guys here. I love these programs.
If anybody ever calls me for medical advice ever, I'm going to blame you, just so you know.
Exactly. Then say, no, not that kind of doctor. Not that kind of doctor. I love these programs that we're having right now because we're answering listener questions and viewer questions, and it gives us an opportunity to solicit them from you. Go to premieriwm.com, click contact, and you can submit a question of your own. Just like Kevin, who asked, I've got money in a traditional IRA and a Roth IRA. How do I know which account to pull from first in retirement? This is really where the professionals come in handy, Elias.
Well, one of the best things you can do as you transition into retirement is start to put together a withdrawal strategy, or otherwise known as a distribution strategy. So that's really an exercise of coming up with a retirement cash flow plan, understanding the types of accounts you have, how they're taxed, the differences. So I think the best way to go about this exercise is, one, let's figure out what are my account types. How are those taxed? Next, what do you need to spend? When you are retired, what is your lifestyle? And when I ask people, what's your budget? And I usually don't use the word budget. To me, that's a nasty word. I don't even like saying it, right? Yeah. Budget sounds boring. No one wants to do it. But what are you spending to have the lifestyle that you have, right? And that's not just your bills. It's not just what you need to pay for to go from this month to next month. Your lifestyle is all of those things, plus your vacations, plus your vehicle upgrades. Are you someone that likes to meet up with your friends 3 times a week and go out to eat?
Yeah.
Right? That's lifestyle spending. So it's all of those things combined. So let's figure out, one, what are the types of accounts? How much do you need to spend? And then what we can do based on that is we can back into the number and back into the withdrawal strategy. And you want to be tax efficient, right? Can you eliminate all taxes? Well, when you're making money, no, you can't. All the ways to just eliminate them are illegal, right, Casey? Like you can eliminate your taxes illegally. I don't think that's what you want to do. So start there. Let's figure out, what do you need for lifestyle spending?
Okay.
What are your account types? And that's a good way to get you on the right path.
Casey, let me go to this because it's something that I know that you all have talked about before, is that a lot of what if time, take even a step back from here, is say, when you sit down with people, say, before we get to how do I know which account to pull from first in retirement, you want them to say, answer the question for you, what does my first year of retirement look like? So you can get an understanding of these things that Elias was just talking about. And
it's definitely a conversation over on there to figure out exactly what Elias was talking about with the different lifestyle and what the actual needs of that household are going to be or likely going to be. But let's even take it a little bit of a step back. I know Kevin is asking this, so he probably has a little bit of an idea. It sounds like he has some pre-tax, some traditional funds, and he also has some Roth funds. But what the heck does that mean, right? If we got somebody who's listening or tuning in, I know our normal people, they know this, they've heard us talk about this a lot, but maybe we've got somebody that
abnormal
just,
like me.
Yeah, they tuned in for the first time, and they're like, I heard the dulcet tones of Douglas Wagner, and they just had to stop that radio dial. So when we look at what a traditional IRA, now this also goes along with traditional 401k, really any sort of a pre-tax account. Essentially what that is, anytime we're taking distributions out of that account, it gets taxed as ordinary income. Now, the rate of ordinary income depends on what your taxable rate is. Okay, so take, for example, in 2025, a married couple, if they're making approximately $100,000 a year, they're probably in all likelihood going to be tipping over into about a 22% marginal tax bracket. So if you're over in that range, we're probably looking at a situation that in that particular instance, distributions would be at a 22% tax rate. Now, if it's less, then maybe it's a lower tax bracket. If you're higher, maybe it's a higher tax bracket, right? And then it also changes if you're single or if you're, if you're married, if you had a household. There's a couple of different filing types. Trusts and estates get taxed much more quickly. They hit the highest tax bracket at about $15,000 of income. Yeah. So they get taxed more quickly. The tax brackets are much more condensed compared to individuals. Okay. So that's what a pre-tax or traditional withdrawal actually functions from a tax standpoint. Roth, you don't have to worry about that. Now, you don't get a tax deduction when you put the money in. But when you pull it out, you avoid the income taxes.
Because you've already paid it.
Because you've already paid it, right? You paid your taxes, so it's a tax-exempt account when you actually pull those money out at some point in time in the future. Now, there's some rules around penalties. There's some rules around when you actually have access to the gains within the account as well. So we want to make sure that we understand when you set the account up and made those contributions, but by and large, it's a tax-free asset, right? So it doesn't matter. I can make $1 million if I'm pulling money. If I make $1 million and then I pull another $1 million from a Roth account, well, I only have that $1 million of income, right? Even though I have spending of $2 million in that particular scenario. So, I guess if Peter Thiel's listening, he can. I
was going to say, whoa, hey, I don't know any of these people. Congratulations.
Well, I was going to say that's. I know they had that ProPublica data that went out here not too long ago, and he did some really smart stuff. I'll just leave it at that.
That's
So so that's really what the big difference is between that pre-tax and that Roth account is just what that overall tax treatment is. Now, to go back to what you were mentioning on there, Elias, when we understand what that overall household income is, and we understand where those assets are located and where they're at, how much we have in pre-tax, how much we have in post-tax, how much we have in taxable, right? That's not even anything that we kind of mentioned. That's not even in Kevin's question. But if we have these three different tax buckets, what is the optimum distribution plan based off of what my tax bracket is right now and what my expectations are in the future? Right now, notice I don't say what I know is going to happen in the future because I think Congress is probably going to change things, right? We don't know what's going to happen 10 years from now from an overall tax standpoint. Now, I tell people all the time when we're doing tax planning, we utilize the law as it is currently written, not the tax code that I want, not the tax code that I fear. The tax code as it is currently written. Now, that doesn't mean we don't go through multiple iterations of this, right? The distribution strategy, and I love how you were talking about that, the distribution strategy that we're using this year, it might change in 3 years because the tax scheme changed a little bit. And so depending on where assets are and how they're set up, we might have to make adjustments, maybe increasing that distribution out of Roth because we're trying to keep our ordinary income down a little bit. Maybe we drop some of those Roth distributions because maybe I now have a legacy aspiration that I need to fund or I want to fund with those Roth assets, right? So depending on the overall situation really encompasses or needs to be taken into consideration with that distribution strategy, and then also some of those legacy plans that we're also trying to create as well.
Well, and that's where, with the work we do, everything's very unique to the family.
Right.
And we're trying to set up each family for their own personal optimal outcome. And, I I can speak a little bit on, okay, just general financial planning philosophy.
Mm-hmm.
Well, general financial planning philosophy is probably going to suggest defer your Roth money, meaning don't take that out because it's going to continue growing tax-free,
Yeah.
Mm-hmm.
right? So start drawing down your traditional pre-tax accounts first. And although I do agree that is good guidance as far as how to think through the concepts
Mm-hmm.
of what we're doing, but that may not be what's optimal for your family, depending on tax situation and goals and those things. So, and that when it comes to withdrawal strategies, that's the other thing I would kind of highlight is, do you want to have a strategy that's working as well as it can for you, or just want to have something that's like, well, that's a good generic recommendation in the ballpark, something you can find on Google, right?
Yeah. I think a lot of it comes down to you don't just Google it. I mean, you have software that you work with, you have professionals that you work with, and you encourage people to work with tax attorneys in order to make sure that they're getting the most out of their money and giving the least back possible to federal, state, county, local government, whatever in this case. But ultimately, it comes down to what you're saying is that it depends on what your situation for taxes are. Is there a situation where you, and again, neophyte, I'm not, at the age where I'm withdrawing it. Is there a situation where you actually are withdrawing both from a Roth IRA and a traditional IRA, and so you have a blended mix of that?
Yeah, and again, I think it's so the answer to that is yes, and I mean it can go the gamut from very early on all the way up until very toward the end of a plan. So there's not necessarily a specific age where that threshold gets crossed, because again, to Elias's point, that's going to be very dependent upon the individual factors of that household. So I'll take, for example, I made just a comment here that maybe we defer those Roth distributions because we have maybe some legacy aspirations that we're trying to leave some money over to somebody. So we're leaving a tax-free, tax-free pool. What if all the beneficiaries are charities?
Yeah.
Why on God's green earth would I not leave them pre-tax funds?
Right.
I want to leave them the maximum amount that I can in those pre-tax accounts, because when they receive it, they don't pay taxes.
Right.
They're a charity.
Exactly.
So who have I cut out in that instance? The government.
Exactly.
Why would I not do that?
Yeah, I
so in a situation like that, right? Even though generally speaking, if we're looking at most individuals, now again, the household income would be a factor over on that as well.
Right.
Generally speaking, Roth assets can be extremely efficient as far as funding legacy aspirations for next generations. There may be some complicating factors in a household that we don't want to fund whatever that legacy is with with post-tax assets.
Right.
Okay, I might want to fund those with pre-tax assets, especially in the for a charitable organization or something like that.
Okay.
Now, as far as like the blended strategy, that can also apply over to our beneficiaries as well. Right? If I have those legacy aspects where I'm wanting to leave some assets over to a charity, and then I also have some kids that I want to help along the way as well. Well, maybe we're taking distributions out of both of those, right? So I'm trying to minimize my taxes, keep myself in that maybe a 12% tax bracket, 22, maybe a 24, whatever that optimum number is for my household. But maybe I'm leaving those pre-tax assets to the charity, and then I leave the Roth assets to the kids. Right? So I've just actually accomplished 3 different things by doing some advanced tax planning to try and mitigate my existing tax liability, and then also eliminating or mitigating some of the taxes that would be paid at the transfer for the next generation.
Okay. It's Casey Mushrush talking with him and Elias Randall from Premier Investments in Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams. Go to premieriwm.com to find out more about what they can do for you. Click Get Started, answer a few questions. They'll provide for you a 1-page Premier Vision document and a free, no-obligation consultation to sit down with them and go through the document so you can find out whether you're ready for retirement or you're not. You can schedule your appointment online, or you can just go click Get Started at premieriwm.com, or you can call 800-383-6590. We're talking about Kevin's question. He asks, I've got money in a traditional IRA and a Roth IRA. How do I know which account to pull from first in retirement? Talk about some of the benefits of a Roth IRA. We start looking later in life, if you will, Elias. Some of the things that you look at and you say, okay, these are really the benefits that show up here.
So there's a few things that stick out. One, with Roth accounts, you're never going to have a required withdrawal or required minimum distribution, as it's called. So that can be something that may be important to families to continue growing that account because you won't be forced ever to take money out. You might be able to keep your taxable income lower, like in years with bigger expenses. So if you think about retirement in a few phases, that third and kind of final phase of retirement, that you're spending more and more money on your health care. It might be nice to have a large amount in Roth still remaining to help cover those expenses. So then you're not dipping into other assets or increasing your tax liability if you're kind of trying to control it as much as you can. And also the distributions from your Roth are tax-free. So I don't think you also don't need to worry about like your Medicare premiums going up or anything like that, because it's not going to increase your taxable income. So there are some longer term items to consider and a lot of pros and cons towards doing that. It's the Roth, and practically just with how people have saved for retirement, I think it's over time, Roth is going to be a bigger part of what we do. Practically most people's money is in pre-tax accounts right now for the generation retiring, is retired and currently retiring. It was not as adopted as much as it is now. So, that's another piece of it is maybe you have a really large pre-tax account, the Roth. The Roth might not even be big enough to like drive any meaningful income. So just kind of let that keep growing, and hopefully it can offset some taxes in the future.
That makes sense.
Well, and I've seen that before too, where maybe it's I don't know, some nominal amount of Roth dollars, and maybe somebody was late to the game, they made some Roth contributions, right? Which I think is what you're talking about on there, but. And it's not enough where it necessarily makes sense to use as a distribution strategy, like monthly distributions, because we're talking like a couple of bucks. But it kind of functions again as almost like a backup emergency fund, right? So I still have that income distribution plan that we are pulling out of the account, but then when life goes wrong, right? And if I end up having to go through all my cash, well, I still have some funds that I can either refill that emergency fund without having to take an additional distribution, which increases my current tax liability, right? Or I have that available that if something happens unexpectedly, I can go dip into that and pull those funds and not necessarily have to disturb my cash if we're in a good spot from a market standpoint that it makes sense to do so.
Casey, when you're sitting down with people, you go over their financial plan on a regular basis. I think it's at least every year. And when you have volatile situations like this, probably makes sense when you're looking at things like this. For what Kevin's saying, how do I know which account to pull from first in retirement? That may change year to year depending on what's happening and as they grow older and the asset allocation.
Well, again, it goes over to that comment I made a little bit earlier that we plan for the tax code we have, not the tax plan not the tax code that I want, okay, and not the tax code that I fear. It's based on the current law as it is written, and that does change not infrequently. So we want to make sure that we understand: do we need to make any adjustments to that distribution plan in light of the new tax law? Now, the other thing on here too, even when it comes over to that annual, we may actually, and this is where things can get really interesting. Depending on where somebody's at right now, we might actually pull some funds out of that pre-tax account, not spend it, okay, move it into that Roth account. So now I'm increasing the overall amount of Roth contributions, or the amount of Roth dollars that are available through that conversion from that pre-tax account to that Roth.
Okay.
Maybe keeping myself within that same tax bracket. So there's some things that, depending on, what current law, where I'm sitting at as far as income distributions that I'm taking, we may shift some of the dollars over simply because it gives us an opportunity to try and really maximize really increase the amount of after-tax dollars in the Roth accounts by utilizing some sort of a conversion process, if that makes sense to do so for that particular household. Now, what's really kind of fascinating they actually closed I'm going to call it a loophole. One of the things that was really cool, we could undo that and redo it.
Yeah.
And they actually eliminated that a handful of
So
years
just go
ago.
back and forth.
Well, so what we could do is we could actually do a conversion early on in the year,
Mhm.
and we could recharacterize it to undo that conversion and then redo it if it was more favorable, because the actual tax consequences are based off of the asset value.
Right.
Okay, so let's just say, for example, if I converted 100 shares of a stock and it was a lot higher at the beginning of the year and then it
Mhm.
went down in value, what we used to be able to do is we could reconstitute it, recharacterize it back as if we say, no, that conversion didn't take place,
Yeah.
and then convert it again at the lower price to increase our income less.
Okay. I see what you mean.
And they
It'd be more
closed that.
tax
They
advantageous.
closed that loophole
Oh.
actually on us a handful of years ago.
How
So
unfortunate is that?
we can still do some recharacterization and undo some of that stuff, but we can't actually take the money back over to another
Gotcha.
Roth. So it is in today's day and age right now, it is more of a kind of a one-time shot type deal that once we trigger that tax consequence, we know what that tax consequence is going to be for the rest of the year.
One more question, then we'll say bye to Kevin and hi to Felicia here on Premier Investments and Wealth Management Financial Program. Doug Wagner along with Dr. Casey Mushrush.
Just to you, Doug.
And Elias Randall here. Go to premieriwm.com, click Get Started, answer a couple of questions, find out whether you're ready for retirement or whether it's your child's education for the future, or maybe you've got a dream purchase in the future. If you don't have a financial plan, this is what they do. It's all they do. They do financial plans. They work with you to help you get your Premier Vision document and your financial vision characterized. premieriwm.com and call 800-383-6590 to make an appointment with Premier Investments and Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams. Now, Elias, there are people you can, if you have the time, talent, or the money, the wherewithal to do this, you can try and do all this stuff on your own, as far as like take a look at tax projections and how do you do all the things. But why would they do that when you guys take care of it all? It just, it doesn't. I remember years ago when fantasy baseball started, I manually collected the statistics.
Ouch.
I know, because they didn't have software available to do that. Okay? Now they have software. Why would you still be doing that when you have the software? You have the software available, Premier Investments and Wealth Management.
We do, and that's truly what we're fulfilling for families is delegation of those things, the technology to do all the planning, the time, the desire, and the knowledge that it takes to do all those things. And with this topic here of withdrawals and distribution strategy, it's one of the most impactful areas of retirement, right? Because now you're done working. So where's your income going to come from? Your income is going to come from your retirement accounts. So one of the best things you can do is to work with a financial planner to figure out, how am I going to do this, right? And we've been going on and on about it. Well, it depends, and the taxes and all this stuff, right? Well, if you have a really good team of people helping you, they're going to get you to those answers.
Yeah.
And one thing I would challenge the listeners to do, whether you're a do-it-yourself or you're working with someone, even if you're working with us, if you haven't asked us this question, it's a great question to ask. How much money can I spend every year and never run out? Don't you think you'd like to know the answer to that question?
Yeah. It's interesting because Roger, we were having this conversation with Roger not too long ago where he had a couple who were clients in here, and they said, well, we'd like to go on a vacation, but we're kind of concerned. He said, well, how much money would you take on the vacation? He said, well, $20,000 for the vacation. He said, how about we plug $50,000? They were, and then they plugged it in. It was still a 99% percentile that they would fulfill what they wanted for their retirement. It's amazing what you can do with these things, and it takes a lot of the onus off of the individual, puts it on you, but I mean, you've got solid software in order to pull it off.
Yeah, I think kind of to go back to Kevin's and kind of to summarize a lot of things that we talked about on that, money in traditional and Roth IRA. How do I know which account to pull first in retirement? Consult your financial plan, and it is going to tell you exactly how much you should and are going to be able to take out of each one of those different accounts.
And here's the thing, as you grow longer in the tooth, as you get older and you acquire more, investments and you acquire more assets and more wealth, it's going to change. And that's when they start putting together this philosophy of how you start pulling this money out. Because if you're thinking at 35, you're going to be able to look at that. Nah, you can have a high level 30,000 foot, but when it gets to the on the ground view, that's what Premier Investments in Wealth Management does very well. Let's say goodbye to Kevin. Say hi to Felicia, who asks, I've been investing for a few years, but feel like I'm just guessing. How do I know if my portfolio actually fits my goals? Casey?
And another really great question, Felicia. Thanks for sending that in. So, I think this is something that we don't necessarily see infrequently again. I would say investing for a few years, that can be anywhere from I'm just starting out kind of at the early parts of my career to maybe a few years is more than just a few.
Yeah.
But ultimately it really comes down to what are you investing for in the first place, right? What is the point of the dollars that you're actually setting aside? I mean, are these retirement dollars? Are these actually allocated over toward a new home purchase? Are you trying to go buy a boat? Is that going to be something that you're doing in the next 6 months or so? But actually naming what it is that you're investing these dollars for can really start to allow you to define the answer over to this question. Because at the end of the day, if you don't know the reason that you're actually saving, right? I'm just saving money. Like, that's not really a good reason. And what I mean by that is it really doesn't have any sort of a way for us to back in and to check and feel whether or not you're actually on track. I mean, maybe it feels like you are, but it just kind of feels like a guess. And it sounds like that's exactly what's going on here. But actually starting with that why of, what are you actually accumulating or saving those dollars for? What are they being allocated toward is going to help answer ultimately what this question is.
It's interesting. When I first started out college, my focus is I wanted to be a doctor. I was a biology and chemistry major. That was my focus. There are kids that I know that are going to college today. Well, what's the point of you going? Oh, I want to get a degree. In what? Well, a degree. I want to get a degree. Oh, okay. A BA, bachelor's. Well, I'll probably want a master's too. Well, what are you going to do? They just no clue. Having the answers to that why is really, really critical. Felicia's talking about investing. She thinks maybe she just be guessing a little bit right now. She doesn't know if her portfolio actually fits her goals. One of the goals you need to have an understanding of is what the time horizon is and when the money that you're going to be accumulating through wealth is when you're going to start pulling the dollars from the money tree.
Well, here's what I love about this question, and it's really true that without clear goals, it is going to feel like guessing. And when we talk about time horizon, so that's the most basic question in investing, right? I have some money, I want to invest it. Well, what are your goals for the money? What is your time horizon, right? That's at least going to get you on the path to what should you be doing. And, with this, because if you ask someone or if you were to talk to someone and, hey, what are your goals? Just to add on to what you guys were just talking about. What are your goals? Well, my goal is to have more money, right? That's not a real goal.
Yeah.
Everybody wants to have more money. Do you know anyone who says, I wish I had less money than I have today?
They're not really successful, but yeah. Anyway.
Okay.
Putting a number with it.
Okay.
I mean, there's a lot of really easy solutions for that particular problem.
Here's my address.
Think of some, right. But even in that case, someone that that maybe they aren't successful, do they want more money?
Oh, like, I'm sure
really, what bad? No. What's bad about having more?
I couldn't agree more.
Right,
I couldn't agree more.
But you do need, one, knowing your why. Why are you doing it? And two, knowing your time horizon. If Felicia, if you're a younger investor, right, you obviously have a longer time horizon. And if how do I know if my portfolio fits my goals? Well, if you have a time horizon longer than 10 years and you look at and you have all of your money in a cash savings account, well, that probably doesn't fit your long-term goals, right? You're not going to get the compounding growth that you need to have to really build up those accounts over time. Now, on the flip side of that, if if this money you're saving is for a shorter term goal, right? You need to spend, this is for a down payment on a house. This is to buy a vehicle in the next 2 or 3 years. Well, the stock market, which is a long-term wealth building vehicle, might not be an appropriate place for that money.
And that's why you utilize what's the premier bucket strategy you talk about.
Oh, yeah. That's one of the main reasons, because that really, the simplest way to think about that strategy is we're taking money and we're just putting different time horizons on different portions of it, or
Different
what we call
purposes.
buckets.
Yeah.
Right. We like different segments, buckets, however you want to look at it. But that's exactly what we're doing. It's different time horizons for different dollars.
Makes sense. Well, the other thing to talk about too, and the same thing is the idea of having risk, because if somebody's got 10 plus years to retirement, and they're just sitting there with all in cash, I mean, they may be really scared, because there are a lot of people right now, they see the volatile market that they've seen over the past 12 to 15 years. If they're just now professionals, they're scared to death of the market.
Right. Well, and I think, again, that's that too. It really depends on how we define risk. Right. You know, I would say, and this is one of the things that I think that we as an industry, meaning financial advisors, financial professionals, have actually done a very poor job about, because what has happened, and this also, I would say, especially goes over to the financial media. You know, like when I hear these horns blaring and sirens going and buy
Crazy
this, sell
cash,
this, all that kind of thing, right? You know, that really isn't really. It's trying to turn something over into really exciting that maybe should not necessarily be if we're talking about actually long-term wealth building strategies. Anyway, that's a whole other thing about that. But when we think about really what this risk is, we want to make sure, what are the risks that we're actually looking at? Is it just market risk? And when I say market risk, it's just the up and down market movement of the prices, you know, that volatility risk, the up and down movement of the price of whatever it is that I own. That's volatility risk. That does not do a very good job of actually representing the ability for me to spend at some point in time in the future. And so when we actually start talking with our clients, we talk about, what is your risk capacity? Right. And when we say risk capacity, yes, that volatility is an element of it. But what I am much more interested in is, are you going to be able to reach with some level of a high probabilistic certainty, right? We know it's never going to be guaranteed, right? But do we have a decent level of probability that at some point in time in the future, you're going to be able to spend the level of income that you want or that you need? And that is a completely different conversation than the overall volatility movement or the market price movement inside of a portfolio. And I always think it's really interesting when we actually talk to our clients about that, and I'll show them, they say, well, I'm really scared of the market. I'm like, okay, well, we're going to run through this on 2 different scenarios. We're going to run a cash scenario. And then we're also going to run a scenario where, you know, it's the highest octane growth thing with the biggest wild swings and all this kind of stuff. And we run those 2 scenarios and we say, okay, you have a 50% probability in that cash account that you can reach your spending goal. It's a coin flip. You know what? Not, you know, the worst thing in the world, right?
It's an outcome.
It's an outcome, right? Maybe about half those outcomes are not ideal, but it is an outcome. If we take more risk or more volatility, you have a 92% probability in that same portfolio with the same levels of spending. So yeah, there's more price potential movement in that portfolio. Which one actually carries more risk? Well, in that situation, the one that's the cash account, that lower volatility, the safer portfolio carries more risk of not being able to spend the level of income that is needed at some point in time in the future. So when we have this conversation that says, what is the risk inside of a portfolio, we need to make sure we understand, what are the risks that we're actually trying to address? Because if it's just volatility risk, cash is fine. Nothing wrong with that. But by and large, that may not necessarily be the risks that we should actually be solving for.
Interesting. Something that's inside of a portfolio too. This is sort of digging down a little bit deeper for Felicia, because she's worried if her portfolio actually fits her goals. You start looking into everybody, they tend to buy mutual funds. You say, hey, Jonas says, I want haystacks, not needles, not individual stocks. I want amalgams, conglomerations of stocks. One of the problems Elias, is that you can end up buying the same thing in a different package, but you open it up and it's the exact same thing, metaphorically speaking. That can put you at greater risk too, can't it?
It certainly can. So that's why it's important to check your overall asset allocation and make sure you're diversified into a portfolio that you feel is best to achieve your goals. And, when it comes to a couple questions of what's your asset allocation, are you diversified? It can be as simple as your mix of stocks, bonds, and cash. But I want to bring up another story of checking asset allocation and being diversified.
Right.
So we took on a new, she's younger, been with us for probably 3 years, young 40s, great saver, someone I would consider what we call a super saver.
Mm-hmm.
And when we first met, looking at asset allocation and is this portfolio appropriate for you was really what in a financial planning investing we would call a balanced investor, which is like half of the money in the stock market, half in bonds. And could that be a great portfolio? Potentially could, but that's really more a portfolio designed for someone who is retired.
Yeah.
Right. So going through our process and being able to show someone, hey, when you look at these things, because I was able to demonstrate, we can move up your date of financial independence just by having a more appropriate asset allocation.
Right.
Well, but I'm just kind of worried about the stock market. As a younger person, that is a fair worry.
Right.
Right. Well, when the market goes down and you're a younger investor, good news, bad news. Hey, the bad news is your account value went down. The good news is you can save more money and take advantage of this buying opportunity. Right. And then on the flip side of that, a risk that not everyone considers, the risk of being too conservative, right? Or opportunity cost, right? So what is your opportunity cost for being invested too conservatively? Well, that may mean you have to work 5 or 10 years longer to reach the same goals.
Right.
Right. So do you really want to trade some fluctuations in your account for working for another decade? And to me, it was such a simple change that we could make to provide value. And it really, to me, showed sometimes people just need a little bit more education and the reasons why you should do something. And then they're totally comfortable and confident in doing it. So that person now has traded a portfolio that didn't fluctuate as much for one that fluctuates more, but ultimately we believe is going to have a better result over time.
And that's what Casey was talking about earlier, that risk of having a portfolio that doesn't have the risk in it, but it risks not achieving what your overall goals are. This is important to understand. Premier Investments in Wealth Management, they understand that. Named to Forbes 2025 Best in Wealth Management Teams. Go to premieriwm.com. They got lots of downloadable information out there. Or you can make an appointment online as well as calling 800-383-6590. Something, especially when you have a volatility, Casey, but in addition to that, you have a number of times, I mean, I don't know how many years now we've had just run up in the market. You have these run-ups. It's good to take a look at if your portfolio is completely out of whack when it comes to things, because you may have things that ran up so high and so fast that they now completely overshadow something else in your portfolio.
Yeah, it's having that rebalance is actually goes part and parcel with something you mentioned a little bit earlier before Elias took a different tangent, which is perfectly fine. But the diversification within a portfolio as well, right? Now, keep in mind, diversification is not the same as duplication, right? And that's kind of what you were mentioning on that too. I can remember a time I sat down with somebody and they had, oh gosh, how many was it? I think it was 15 different accounts in various different places. A couple of 401ks, and they had all this. And I mean, things were just scattered all over the place. Not a lot in every single one, but it was just a whole bunch of different places. It's like, okay, well, why do you have so many accounts? Oh, I'm diversified. Okay.
Yeah. Don't Don't want all of our eggs
Right.
in
Don't
one
want all the
basket.
eggs in one basket. Like, I want diversification. That's what they said.
All the same eggs in different baskets.
It was all the same eggs in different baskets. That's exactly what it was. So, I mean, all they did is they owned the same thing just 15 different times, right? So duplication is not the same as diversification. Now, along with this idea, when it comes over to rebalance, when we have a truly diversified portfolio, it means that we might own some growth style, large cap growth stock, right, which has performed exceptionally well over the last decade. Maybe we own some value stock that hasn't performed quite as well, but maybe it's important because we're looking for some cash flow coming into the portfolio. Maybe some blend. Maybe I own some smaller size companies. Maybe I own international, right? But when we have these rebalances and these reviews that actually happen, we're trying to take ourselves back down to the baseline, right? So to go to Elias's mention of like a 60-40 style portfolio or something like that's a traditionally retirement style portfolio with some cash producing assets in terms of that fixed income, plus some growth engine assets in terms of that equity. Over time, if we never touch it, what the expectation would be is that we may be an 80-20 at some point in time because stocks have grown significantly faster than that fixed income asset or that fixed income bucket has in that asset allocation. So rebalancing simply takes us back to what our baseline or what our anticipated or expected asset allocation is. So another way of looking at it, because the old stock market adage, buy low, sell high, right? Rebalancing forces us to do that.
Right.
We sell out of things that have performed extremely well, and we purchase things that maybe have not performed quite as well. And really, when diversification works, it works extremely well. Take, for example, during in the 2025, in the April timeframe, on a year to date, international was actually up pretty significantly compared to all the U.S. That has not been true for an extremely extended period of time. International has actually significantly outperformed U.S. stocks. And we did see a period of time where that diversification actually did exactly what it was supposed to do, which was permit other parts of the portfolio not to perform exactly the same, to allow those rebalances to take place and to make sure that we are doing the right things and forcing ourselves to do the right things by purchasing the assets that are depressed in value, selling assets that have actually extended or have increased in value.
Preach.
Take a breath. My goodness, I was going to say, I'm starting to get a little bit of, I'm getting a little emotional about that one right there.
Well, and that's one of the first.
Go read some tax law.
And that's really one of the first things to think about or to ask people. Certainly, because a lot of times when things are going really well, right? Mm-hmm. Anytime the market's all-time highs are close, people start to get a little bit nervous.
Yeah.
So that's one of the first things you can do is look at, well, when was the last time you rebalanced your portfolio?
Premier Investments and Wealth Management. Really, when you think about doing this, as Felicia and for anybody else, think about getting a financial plan. You're saying, how do I know if my portfolio actually fits my goals? Well, if you don't have a financial plan, you don't know that. And you know what? The best way to get a financial plan is to come to a financial professional, a wealth advisor, to get that done. Premier Investments and Wealth Management at premieriwm.com. Very easy. Just click Get Started once you get to that webpage and answer a few questions. They'll provide for you a one-page Premier Vision document. Very simple roadmap. It's got your short-term, medium-term, long-term goals. It's got action steps for you to take so that you can have metrics. But not only that, you get the team at Premier Investments in Wealth Management as well. They were named Forbes 2025 Best in State Wealth Management Teams. I love working with them. I think that you will enjoy working with them as well at premieriwm.com. Make your appointment online. Or, Elias, you can make a phone call. The number is
800-383-6590.
For Elias Randall and Dr. Casey Mushrush.
Just you, Doug.
I'm Doug Wagner. Thank you for joining us for another edition of the Premier Investments in Wealth Management Financial Plan. We'll see you next time.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Economic forecasts set forth may not develop as predicted. and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Forbes' Best in State Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firms. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.